Dear students, this video is going to cover taxation. It's not one of those fun things to do, but it's really important. It can get you into deep trouble because you don't want to mess with the federal government when it comes to taxation. Just pay the person and be done with that part. So you will learn a little bit here, but you will learn more about taxation and tax law and accounting and in legal studies. But we'll have a start right here, so enjoy. This video will cover taxation. International taxation is really the study or determination of tax on a person or business subject to the tax laws of different countries. International taxation can become very complicated because it has to do with different types of agreements between countries. To keep things simple, I'll look at the object of taxation. One is tax neutrality and another one is tax equity. First, let's look at tax neutrality. Capital export neutrality is the tax scheme that does not incentivize citizens to move their money abroad. National neutrality is that taxable income is taxed in the same manner by the taxpayer's national tax authorities, regardless of where in the world it is earned. Capital import neutrality is a tax burden on a multinational corporation and their affiliates should be the same regardless where in the world the multinational corporation is incorporated. Now, when it comes to tax equity, however, it's the idea that regardless of the country in which an affiliate of a multinational corporation earns taxable income, the same tax rate and tax due date should apply. The principle of tax equity is difficult to apply because the organizational form of the multinational corporation can affect the timing of the tax liability. Income tax is a tax on a personal and corporate income. Many countries in the world obtain a significant portion of their tax revenue from such taxes. An income tax is direct tax that is one that is paid directly by the taxpayer upon whom it is levied. Before income tax, it was customs and tolls that was the main source of revenue for a nation state. Withholding taxes are withheld from the payments a corporation makes to the taxpayer. The taxes are levied on passive income earned by an individual or corporation of one country within the tax jurisdiction of another country. Passive income includes dividends, interest income, income from royalties, patents, or copyrights. A withholding tax is an indirect tax. Value-added tax. A value-added tax is an indirect national tax levied on the value added in production of a good and service. In many European and Latin American countries, the value-added tax has become a major source of taxation on private citizens. Many economists prefer a value-added tax on income tax because it incentivizes effects of the two taxes differ sharply. An income tax has the incentive effect of discouraging work. A value-added tax has the incentive effort of discouraging consumption, thereby encouraging saving. Value-added tax are easier to administer as well. While taxpayers have an incentive to hide their income, producers have an incentive to make sure that their upstream suppliers in the production process declare the value-added tax and actually pay the tax. In Europe, value-added tax is used to discourage certain types of consumption. Value-added tax was recently added to plastic bags in Swedish grocery stores. The Swedish government wanted to discourage people from using plastic bags, so they increased the tax so high that at this time it's more expensive to buy a plastic bag in a grocery store to put your groceries in than it is to buy a gallon of gasoline. Sorry, they don't use gallons over there, they use liters. So it's 1 liter of gasoline is more expensive than a plastic bag in a grocery store in the nation state of Sweden. Other value-added taxes that are used around the world is maybe having value-added taxes that are very significant on energy, especially dirty energy, meaning that if you have energy derived from oil or coal, they would tax it higher just to incentivize that you will use a greener alternative and stop using fossil fuels. Now, if all the taxes are too high, it doesn't incentivize anyone to really save because they don't have any money left to save. They have to consume for their bare necessities. And in some cases, the governments decide what those are by having lower taxes on things that the governments think that you should have, like milk, bread and cheese, while making frivolous spending expensive. Foreign tax credits allows taxpayers to recover somewhat, some, not all, a little bit, dribbles, from double taxation. Direct foreign tax credits are computed from the direct taxes paid on active foreign source of income of a foreign branch of a U.S. multinational corporation, or withholding taxes withheld from a passive income. An indirect foreign tax credit are for income taxes deemed paid by the subsidiary. Now, all of these different taxes that are out there, you're going to learn more about that in accounting or tax law. Dear students, I hope you liked this video. If you did, please subscribe by clicking up here and give me and maybe even write a little comment down below. So I appreciate your help and your support, and I hope you enjoy these videos on finance.